Welcome to FYI, the For-Your Innovation podcast. This show offers an intellectual discussion on technologically enabled disruption, because investing in innovation starts with understanding it. To learn more, visit arc-invest.com.
ARK Invest is a registered investment advisor focused on investing in disruptive innovation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. It does not constitute, either explicitly or implicitly, any provision of services or products by ARK. All statements made regarding companies or securities are strictly beliefs and points of view held by ARK or podcast guests, and are not endorsements or recommendations by ARK to buy, sell, or hold any security. Clients of ARK Investment Management may maintain positions in the securities discussed in this podcast.
From ARK Invest, this is FYI, the For-Your Innovation podcast. I'm Brett Winton. We have a great show for you today. We're interviewing Nikil Viswanathan, who is the founder and CEO of Alchemy. Think of it as the AWS for developing to blockchains. Lorenzo Valente, who's our Director of Research and Digital Assets, and I talked to Nikil about the smart contracting space, as well as advances in kind of cryptocurrencies and how the regulatory landscape is changing financial institutions' willingness and even eagerness to get involved in crypto. It seems as if the tide has turned, as you'll learn from the interview. At a high level, we think that the innovation in public blockchains can be distilled into three distinct technology exposures. There's cryptocurrencies, of which Bitcoin is the premier and dominant example. You should also layer in stablecoins into the cryptocurrency landscape as a set of likely synthetic dollars that will infiltrate the world as a stable unit of account for people to use. There's smart contracts, and this is everything happening in DeFi space. These enable you, the average person, to effectively write your own risk transformations. What do I mean by that? I would love to be able to insure my house against a counterparty other than the current Californian insurers. I want my house to be underwritten specific to its risks rather than lumped together with everybody else in California, including those in regions that are about to catch on to fire. And DeFi over time could enable that kind of activity where you have specific lending and underwriting to the individual, funded by a competitive set of actors that are trading and trying to get a risk-adjusted return on capital within a highly liquid and customized set of capital markets. DeFi should enable that. And then digital wallets, which become increasingly important as our financial lives are increasingly complicated. So you can imagine a fiduciary AI agent living on top of a digital wallet, serving as your risk transformer, your mechanism by which you kind of like keep your liquidity going and provide great compounding return to your wealth, all operating natively against the public blockchain space. So on the cryptocurrency side, Bitcoin is around $2 trillion today in fully diluted value. If you attribute a share of Ethereum's market cap to cryptocurrencies, you probably get to around 2 trillion. And we think Bitcoin could go to $1 million a coin by 2030. That's at the higher end of our that's the midpoint between the middle of our forecast and the high end. So net $20 trillion in potential attributed value there. And the right way to think about the measurement is against global M2, which we think is going to go to around 150 trillion by 2030. Actually, not that much appreciation in that money supply, since there was a lot of money printed during the pandemic, and GDP, even with our expectation of an accelerating GDP, is still catching up to the amount of money in the system. So 20 on 150 would be a way you could think about how much appreciation we're underwriting into the cryptocurrency space, of which Bitcoin is the likely winner. So how do we think about the smart contracting space? Well, smart contracts are an effective displacement of traditional financial intermediaries. You can imagine a bank takes your deposit and it pays you interest on that deposit. Seems like a good deal. Well, why are they paying you interest on that deposit? Because they are taking those deposit dollars. They have to reserve some onto their balance sheet, but most of them, in fact, 90% of them, depending on the regulatory regime, can be lent out to somebody on the other side. And they can be lent out at more than the amount they're paying out for in interest for you to deposit with them. That's called the net interest margin. So they borrow from you. You are a lender to the bank at 4% or less, and then they lend to somebody who's trying to buy a house or somebody who's behind on their credit card payments at in the house side, maybe 7% on credit card payments, a lot more. The difference between those two, the net interest margin, is the revenue the bank gets for providing the services it's providing. What services is it providing? Well, for you, it's keeping track of your money and making sure they don't lose it. And the regulator is ensuring that they won't lose it. And for the borrower who's trying to buy a house, they are basically pulling money forward from the future and giving it to that borrower so that they can buy the asset and kind of live in it at a predictable price over time. And so they're transforming, they're moving financial resource through time and space. They're also potentially taking deposits from somebody who lives on one side of the country, and they're lending out in another side of the country. So they're also balancing the financial flows within the ecosystem. So these are economically useful things to do, and we pay a lot of money for them. So on average, the banking system as a whole, not just in the deposit lending spread, but in facilitating trading on Wall Street, in underwriting IPOs and taking a fee for bringing IPOs to market, in providing you and me and everybody with house insurance. They are basically taking financial wealth out of the system and paying the financial intermediaries for the risk transformations they provide. On average, they scrape more than 3% out of the global economy into this financial intermediary channel. And in fact, it's, I think, 3.4% on the last data that we calculated. That seems like, oh, that's a small percentage. That's not so much. It's a huge, huge dollar amount. We think that, give or take, the number of financial assets that will accrue onto the global balance sheet will reach roughly $1 quadrillion by 2030. So 3% sounds like a small amount. It's on the order of $30 trillion going to financial intermediaries. So people ask within the public blockchain space, well, where is the cost decline in blockchains? We think that if instead of using that bank's balance sheet, its big, hefty office footprint, all of its branches, and the lawyers that have to sit inside to write the contracts that they're trying to follow. If instead of using that channel for these risk transformations, you could use smart contracting protocols, you could use public blockchains, then the net fee taken out of the real economy to deliver this risk transformation service could fall from 3+% to around 1%. And the 1% wouldn't go to paying for bank office space. It wouldn't go to paying lawyers their salaries. It would go partly flow through into securing the underlying protocols that are offering the promise that these transactions that have been designed to trigger will execute when the contract trips, and partly into application layer services that sit on top of those contracts. Out of all of that, we derive our expectation for value accrual to the smart contracting platforms. So of the quadrillion dollars in financial assets, we think it's a little less than 5% will be tokenized. We map the adoption curve to the dial-up days of internet adoption curve. And we think that people will value these tokens that secure these smart contract protocols on the yield that they deliver for providing the service that these protocols provide, which is, making sure the contracts that are designed to them execute and can't be torn up by the authorities. Net of all of that, we end up with an expectation for $5 trillion in value for smart contracting protocols and application layer by 2030. And so it's actually a different set of exposures than the core cryptocurrency exposures. And it's in some ways the most fascinating because one of the potential outcomes is more and more of the world gets transformed into a financialized asset. And it means that you can kind of actually abstractly trade one service for another more consistently and with more assurance that you're getting fair value for the trade that you're making. And that could be anything from, am I getting this plane ticket at a fair price given how far in advance I'm buying it, to am I getting a fair price to insure my house against fire? So Alchemy, Anil's company that he co-founded, promises to make designing to blockchains as simple as designing a web application is. And so really wants this space to evolve in the direction that we're anticipating that it will. I thought his commentary on kind of the traditional financial services and their approach to this space, where they actually have a lot to lose as it grows, but I think they're beginning to recognize that if they don't step into this opportunity, they're also going to be in a huge heap of trouble in terms of the competitiveness of their services. And so kind of the evidence that they're turning on to this now that the administration has turned, I found fascinating. And generally, I think he does a good job laying out exactly how he envisions this technology being used. So please enjoy the conversation with Nikil Viswanathan. He's the co-founder of Alchemy. And thank you for joining FYI, the For Your Innovation podcast. Nikil Viswanathan, welcome to the FYI For Your Innovation podcast. You are the founder of Alchemy, which is kind of like an AWS for developing on kind of decentralized protocols, blockchains. You're in Forbes 30 under 30. Hopefully that does not mean you're going to be, imprisoned at sometime in the next 5 years. And came out of Stanford, have created an amazing company. Tell us about Alchemy and the mission to bring the blockchain to 1 billion users, please.
Thank you guys so much for having me. It's really exciting to be here. High level, what we do at Alchemy is pretty simple. We're the infrastructure layer that enables people to build in crypto. So when you think about the big shifts in technology, there was really 3 shifts over the last 100 years. The first one was the computer. The second one was the internet. And then third one is blockchain. And for each of those shifts, there was always a developer platform powering the space. For the computer, that was Windows and Mac. The operating system is what enabled developers to hide the complexity of RAM and CPU and hard drive and build really great applications like Excel, Word, Chrome. This is what enabled, all of us to use computers. When you look at the internet, there's a similar business that you've heard of, that you've never heard of, called Amazon. Amazon has 2 businesses, one where you buy things, the other one where they make all their money, which is Amazon Web Services. Anytime you open Uber or DoorDash or Airbnb, Amazon is actually running all the computers underneath that. So that Amazon business effectively powers the internet. And what we do is very similar. We are the layer underlying crypto. So whenever you use an NFT or you're buying and selling crypto or you're using a financial application of crypto, we're probably powering the technology under the scenes.
So I think you can tell how early kind of like a technology infrastructure or kind of business model or I guess transition is by how complex people try to get into describing how it works, you know?
Right.
And so it's like when the internet arose, everybody needed to learn like the whole protocol stack and that all got abstracted away. And here we are in blockchain space. And like conceptually, it makes sense. Hey, I want to live at some kind of like layer above the underlying stack where I don't care what's going on underneath the covers. I just want to be able to transfer this digital asset from this account to this other account frictionlessly and seamlessly. And we've had even internal debates over time. The whole point of public blockchains is to create a layer that is kind of like uncensorable, that is in some ways kind of like, isn't it important to pay attention to that underlying stack? Because Ethereum offers like maybe a higher level of certainty that something's going to go through than Solana, and Bitcoin offers an even more kind of like, this transaction went through, so I never have to worry about getting rolled back again. Are we just past that stage where it's just like users care about kind of execution, or is that part of the services that you need to provide to kind of like your developers and to users generally? Should I not care about that at all, basically, as an NFT owner?
It's a really interesting question. So this is actually something I tell our team and share in talks pretty frequently. You will know when a technology has matured and has reached mass adoption when you no longer talk about the technology. Like, that is the hallmark, right? When you went to dinner last night, do you say, oh, I used a computer application to call a car, and then I used an internet application on my computing device with a, peer-to-peer protocol that let me pay for my dinner? It's like, no, I called an Uber and used Apple Pay, right? When we are still talking about the technology, you are talking about the technology in an effort to convince people that this new technology is worth trying, but it's actually counterintuitive. And the time when the technology is worth trying is when you no longer need to talk about it, because the value that it provides stands on its own. And I think that is a true test of where an industry is. Blockchain is still very early. A lot of the explanations you see around, here's a specific technology, here's why it works, here's why it's better, we're in the building phase. If you look at the first paper, artificial intelligence is blowing up right now. The first paper on artificial intelligence was published in like 1940 something, right? I think it was in 1948-ish, around there. And this is like 80 years later that AI is now blowing up overnight. Cryptography has been around for a long time. Bitcoin started in 2009. But I think there's this period over the last several years where we have made very drastic advances in the user experience and the value. And I think that's kind of with three things. The first thing that needed to happen was scalability. So you needed to be able to send more transactions through the network and be able to support large use cases. The second thing you needed was user experience. So you basically needed the ability for someone not to have to memorize this long seed phrase of numbers or lose all your money if you happen to misplace your thumb drive. That needed to go away. And we've made really great advances there. And then the third one is kind of related to the first one, but you needed to have enough capacity for the network to run. So, and this is a mix of through transaction fees and also the ability for enough transactions to happen. So now with layer twos, and you see Solana and you see a bunch of other chains, the cost of transactions has actually come down because we have more capacity, you have more throughput, and the user experience is a lot better. So you're able to have a big step function in terms of usability. So the short answer to your question, I don't think we're there yet, but we've made good progress in the last 3 to 4 years.
Nikil, one question. I think it's very interesting, the analogy with the internet. It does seem though for the last 5 years, I mean, really even since we've had smart contracts, we've been investing and talking with infrastructure all day long. L1s, L2s, different VMs, account abstraction on the custody side, full node, light node, archival nodes. Do you think we're going to get to a point where we're going to be able to abstract all that? Are we very early in that journey? What do you think of that?
I think in any situation, it's hard to predict. I unfortunately don't have my Back to the Future car where I can go teleport to the future and figure it out and come back and tell us today. That being said, I think there's a few fundamental building blocks around why these infrastructure pieces have gotten so much attention and so much excitement. One of them is the space is very early, which is very true, right? I still think we are in the very early innings, right? If you look at the late, 1990s when all the .com bubble was happening and everyone was building an internet company and there was so much excitement because there were so many people who were making money on this, it felt at that time that everyone had everything on the internet that would be invented could have been invented, has already been invented, right? And I think when I was in college and high school in the late 2000s and early 2010s, it was that same feeling. It felt like everything that will be invented has already been invented. And I look back and I was like, wow, that was so early. We didn't have Uber, we didn't have Instagram, we didn't have TikTok, we didn't have DoorDash, we didn't have all these different these products and services that we use today. Looking at crypto is still very, very, very early, which is exciting because that's why there's so much opportunity. And the second piece of this is the reason there's so much infrastructure and the reason that there were so many companies in the late 1990s and during dot-com bubble is there's a very easy way to make money, which is by launching your own token. So you can launch a token or a network, and there's so many great protocols that have so much value and provide real utility, but then there's also protocols which may not have the most utility, but they're able to monetize very well. And that is the reason you're seeing so much infrastructure. So I think it's a combination of it being early and a combination of an easy financial model built in.
Yeah, it does seem like it's hard to the infrastructure is intrinsically tied to kind of like the underlying economics in a much tighter coupling, which has, call it downsides and upsides. I mean, it means that you're much more in kind of like a market mania cycle.
Exactly.
And you would argue like much quicker cycles. How has, and Alchemy has, navigated it well. It looks like strategically fundraised at the right times. How do you think, like, I would say from the average friends I have, the not like ARK friends, their thing is like, what is the point of a thing to do meme coins? This seems like the dumbest use of capital on earth. How do you like counter that narrative? Does that narrative need countering? Like, are meme coins actually, productive and useful in some way? How do you think about that?
So the way I like to think about this is maybe zooming out a bit more macro. What is even the purpose of crypto? Like, why does this like chain exist? Like, what do we get from it? Is it actually valuable, or is it just people making money, right? And scamming other people, which is a valid question. It's a very valid question. The way I like to think about it is, let's get a bit philosophical. Let's think about the telephone. Telephone was invented in the early 1900s. From around like 1915-ish to 2004, 5, basically nothing changed in the telephone. You could call longer distances and it got cheaper. That was basically about it, right? And the reason was the telephone was controlled by two or a few companies, right? It was controlled by the handset manufacturers, and it was controlled by the cable companies like the AT&Ts. And, the Samsungs and the AT&Ts controlled the phone. And no one else was able to innovate on that. You couldn't go build, it was very hard to go build your own physical phone. You couldn't go lay your own, fiber optic network or, cellular network. That was not some, hacker in college could do on the side. And suddenly in 2000, this thing called the internet really took off. And the phone experience exploded because now anybody could build a phone experience. What was the phone experience? Now it's Skype, it's Zoom, it is FaceTime, it is text messaging. It's like you can communicate with anyone, anywhere around the world instantly in group messaging in any format, any content for free, anytime, right? And that innovation really happened about 10 years, 1/10 of the time that it took from the beginning of the phone to not much innovation. And it was really happened because the innovation was unlocked from just these couple companies, the handset manufacturers and the cell tower manufacturer, the AT&Ts. And now anybody could innovate on the phone experience because of the internet, right? Another similar example, you look at the TV, it was basically the same. First 100 years, basically nothing changed. You went from one channel to many channels and black and white to color, and slightly bigger screen and more pixels. That was basically it, right? For the first 100 years. And then because Comcast and again, Samsung are the ones who make the TV experience, and they didn't have this huge reason to innovate. Suddenly internet comes along and it explodes. In like 10 years, what do you get? You get Instagram and TikTok and YouTube and whatever, Snapchat. It's like you can communicate, you can consume, and Netflix, you can consume content in any format you want. You can create it, you can distribute it, it's ubiquitous, it's short form, it's free, it's long form, whatever you want. And that, again, because of the internet. Now you look at money. This isn't a 100-year-old thing. Banks and governments have been around for 5,000 plus years, right? And if you look at a Comcast, they look like a tiny, scrappy startup compared to like banks and governments. So the idea here is that for the first time in human history, potentially the most important facet of people's daily lives is now about to be unlocked for innovation that anybody can build on, right? And that is why it's so game changing. And if you think about it, on the computer or the internet, it was very hard to predict what would happen, right? So for example, especially the computer, imagine if I said, hey, Brett, I'm going to come give you this device. And you're like, okay, what can the device do? And you're like, well, it's a bunch of chips and it can add numbers really fast. And you say, okay, but like, what can you do that? Well, it's like, well, you can make a really fast calculator. It's like, well, but like, calculation's not that hard. So it's very hard to think, well, if you have a bunch of chips, you can add numbers. If you add numbers, you could potentially make like a terminal. And if you have a terminal, you can make a graphical user interface. If you have a graphical user interface, you could make an application. If you have an application, you could have someone pick you up in a car, right? It's like, that's like a big leap. So I think now you look at it, you say, okay, before nobody could build on money. Now you have programmable money. So that means money used to be like the post office, right? You used to send a letter to someone. Now you can send an email. It's like instant. And now because of that instant communication, you can build all these apps on top. So now instead of doing a wire, which takes, multiple hours, if not multiple days, depending on how you do it, you can have instant money transfer and you're not regulated by, or money's not in the control of a bank. You own your money now. And what types of applications can be built on it? It's like immediately you start seeing things like you can loan out your money and get better interest rates than you get on a bank. You can do things that were never possible before, like flash loans. You can send money instantly to anybody anywhere around the world and they can access it. It's like these are just the basic things. We're in the kind of terminal days of the computer. We're in crypto. So I think there will be way more types of new applications that we built that none of us can even imagine. And we're just starting out. I really think we are in the 1980 or early 1990s where it's the green screen and the black text version of crypto.
Yeah, I mean, the way we think of cryptocurrency as like really a different kind of like set of actions than the smart contracting space, which is kind of what Alchemy is enabling. Where cryptocurrency, you can think about Bitcoin as being, I don't know, 2.5 trillion against 140 to 150 trillion monetary or M2. So it's like penetrated, whatever that works to, like less than 2%, and smart contracting, like we map adoption curve to like the dial-up internet days. We haven't even gotten into like broadband, and still end up with an expectations for 5 trillion in attributed market cap. And it's on the basis of there's a quadrillion dollars in financial assets, at least by 2030, globally. Yeah. And so like, if you do all of the math, like what does the financial ecosystem take out of the economy to like manage risk transformations and all the stuff it does, like, take depositor money and lend it to borrowers, et cetera. It's 3%. It's more than 3% on a quadrillion, 3% take rate. And so like when you convert into smart contract land, we think that clip rate converts to like 1%, accruing to the app developers and the protocol developers. So you get a 2/3 savings. Yep. And then we think the underlying tokens, trade basically based on the yield they get and applications. But it's like there's a quadrillion dollars out there that is actually hard to manage, hard to like move around. And there's all of this, call it like risk transformation that could happen that doesn't happen because the fixed cost of creating the incremental contract is so high. Like, a meme coin is interesting, not because I'm like interested in trading Trump coin, but it's in some ways, it's like a proto prediction market of like, is this thing going to have more cultural relevance or less cultural relevance in the future? But what I care about is like the micro neighborhood fire risk. So I can actually get, well-priced fire insurance through a decentralized protocol rather than going to State Farm, which is in California no longer operating. And so it's like, there's like plenty of kind of like examples where the financial ecosystem as it currently exists doesn't actually meet what end customers need. And so then kind of like the allowing developers to develop on top of it actually will provide a lot of capital allocation efficiency in the overall economy.
Exactly. And it's really interesting you bring up that example. That's a great stat. I'm going to start using that, the quadrillion dollars. I think the way to look at it, and to address your meme coin question earlier, is that you need to judge the technology based on the potential it has, not on any specific application. I mean, the early internet, what was the most popular thing on the early internet? Gambling and porn. That's usually the most popular thing on any industry, right? And I think cryptos is very conducive to gambling. So I think the question here is, if you look at that and in 1988, 1999, you're like, very similar parallel. You see a lot of companies that had these businesses that would they sustain in the future? No. Like a lot of the .com companies died, right? Webvan, Pets.com, all of these different companies. But it didn't mean that the internet was bad or the internet wasn't good, right? You could look at certain applications and you can poke at that application and say, will this application succeed? And I don't think anybody here is in the industry is staking their reputation on saying, hey, I believe Trump coin is the future of crypto and it'll be around for 100 years. I don't think anyone's saying that, but I think what a lot of these newspapers and journalists sometimes misunderstand is that this is one application. Of course, you're going to see kind of a flurry activity. Most of these things will not be around and in the future. However, the kernel of the technology, everything that starts as great technology, everything that ends up being great technology always starts as a toy. And I think that is you look at the first computer, it was a toy. You look at the first internet browser, it was a toy. These things look silly and they don't look like real companies, which ironically is why the great companies, the IBMs, miss the innovator's dilemma aspect of it and miss on that innovation. So I think you look at what are the concrete applications of crypto, and crypto industry has actually delivered several concrete applications. They're still early. The first application, and I think living in the United States, most people don't understand this, is having a money that you own that is free from government inflation. And that is living in the United States last couple of years, people starting to realize. But before that, I had a friend I lived in San Diego for a little bit during COVID, and I had a friend, and he actually had fled Brazil during the time he lived there. He had saved all his life savings, and the government had some corruption, and basically they inflated the stock market, and he lost 2/3 of his life savings within a matter of months. But he's able to convert his money to crypto in Monero or randomly, and left the country, and then ironically ended up doing really well because the price went up a lot. But the point here is the first application is Bitcoin and a stable money supply. And it's interesting because it looks volatile to us, but relative to other countries, very stable. The second application, and most people don't realize this, is actually crowdfunding. So before, the ICOs, a lot of them got bad reps, but I see this a lot. I see entrepreneurs, we have a venture arm and we help entrepreneurs around the world, and I get a lot of pings personally. If you live in Silicon Valley and you went to Stanford and you have the connections, you can go do a fundraise. But if you don't, if you live in India or you live in Africa or you live in Chicago or you live in Boston or Florida, it's hard. It's hard. You don't know people in Silicon Valley. It's hard to go raise money. And one of the reasons that Silicon Valley is there's access to a lot of capital that is high risk capital that will invest in you. And now you have this ability anybody can go raise money, and that wasn't possible before through an ICO. And I think that yes, of course there are a lot of scam ICOs, but the mechanism of this is really powerful. Maybe one more point on this. I actually think it's completely unfair that the best investments get limited to people with the most money. The accredited investor laws, you have to have $1 million in order to invest in private companies. Why is that the case? I understand customer protection, these kind of things, but it's also just helping the rich people get richer. And then the third application, what we're seeing is this idea of NFTs. NFTs get branded as art, but they're not actually art. It's the idea of digital ownership online. Today, you can't own anything online really before there's NFTs. Anybody could just copy it. In the real world, you own a car, you own a house, you own your computer. And yes, you own art also, but art is I don't own art, but some people own art. And art is one piece of the things you own. So I think today NFTs are for synonymous with art, but that's just one application. Maybe in the future if you own a house, you have a digital representation that you can prove that you own it. So I think there's a lot of really interesting applications being played around with, but those three fundamental things, the Bitcoin, the ICO, and NFTs, I think are some of the core building blocks which applications of the future will be built on.
You all have some kind of partnership with Worldcoin, right? Do you think like a unique ID per person, like Worldcoin is presenting, is another important piece?
I think that's ultra important. And it's actually really, really exciting. We have a lot, it's like your children, we don't pick favorites, but Worldcoin is like very, very exciting. It's an incredible team, incredible application. And basically the concept for anybody who's not familiar is right now there's a bunch of bots on the internet. I think probably the analogy that most people can relate to is you get a lot of spam. A lot of those spam emails are not from humans, they're from bots that are just sending you spam, or you're getting phished or whatever. And the idea is like, how do we build an internet where you can know that someone's human? It's actually very difficult to do. But I think the Worldcoin team and the WorldChain team has done like an incredible job. Basically, the way it works is there's this big orb, and it's like this physical metal ball, and it scans your eyeball and proves you're human and gives you a digital ID. And we've done a lot of work with them. We power the whole chain, we power their account abstraction. We just did this thing where it's actually really cool. So now they have a blockchain where we did a bunch of custom work with them on the full stack. And now you can, if you're a human, your transactions get prioritized. So over bots and spam, and which is incredibly exciting. And I think this has the chance to be the substrate for all these other applications being built in the future, financial application. Like imagine if you're having digital finance, you want to know that this person's a human, not like a bot. So how do you do that? World has the ability to give you that.
Yeah, I'd want to know it's a human so I could take advantage of their pricing inefficiency. I think.
Exactly. Or if you
but wait, isn't that humanist? Like prioritizing human transactions over bot transactions? I don't know.
Yeah,
I don't know.
It is
Maybe
humanist.
we should be prioritizing the bot transactions.
We got to fight for our species.
Nikil, shifting gears, I want to talk about institutions a bit. I just came back from DAS in New York, and it really seems like this year is the year of institutions, that they're ready to interact with crypto, I think, in a big way. And you guys sit at in a very special place. What are you seeing like from Alchemy's perspective?
Oh man, it's been absolutely nuts. I'm glad they still let me on stage in a t-shirt, and when everyone else was on suits, I had to represent the engineer in me. This has been the most marked shift. So a little bit historically, let me give you a little bit of the historical landscape. And great question, by the way. So we started in 2017. And 2017 was one of the earlier crypto cycles. There was a lot of excitement around crypto. We were working with some of the larger banks. I probably shouldn't name names, but think of like some of the larger banks in the world. In particular, there's one, probably like the largest bank in Europe, or one of the largest banks in Europe, had built out a research team. They were doing experiments with doing loans on chain and bonds on chain. And basically, after 2017, everyone killed all their stuff. They said, crypto's not a thing. We're not doing this anymore. That was funny. Okay, let's move on. 2021 happens, and you see another resurgence. And I think this time, it was, during that time, there was a lot of excitement. We, again, were working with some of the largest banks and financial institutions in the world. And what we saw then was they were really like doubling down. After that crash, and just to help you understand the risk profile of a bank, as a bank, you are heavily regulated. And you're going through this time when, hey, there's this cool, potential, interesting thing that is happening, but it's very small. It's going to be a very small part of your business. At the same time, you're getting massive pressure from the Biden administration. And I think we know now, like a lot of these things have been uncovered. There was soft pressure, there was hard pressure, there was threats, there was force saying, hey, if you do this crypto thing, we will have to audit you, regulate you, all this stuff. And if you're a bank, you run that. It's not that they're not dumb. They're smart guys, right? Or smart women or men. They say, okay, our core business is 99.9999% of our thing. This crypto thing is like potentially 0.00001%. We're not going to risk the whole core business for this crypto thing. Totally makes sense. So it was kind of the difference in 2021 versus 2017 was everyone was still excited, but it would be pockets of people in the firm. There's this 5-person team, 3-person team, 20-person team that's like experimenting, but not this full-on bank. In the last 1 month, we have seen a complete reversal. Like I just like don't even know how to explain this. And if you've worked with large financial institutions, which you guys obviously have, so things are not measured in days or hours or even weeks, to be honest. Like typically they're measured in quarters or years or whatever. So in terms of movement and building and shipping and launching new products. And as not blaming them, there's a lot of regulatory hurdles. They want to make sure there's a lot to lose. They want to make sure that they're following all the rules and everything. the kind of three big shifts: Trump administration coming in, politics aside, Trump administration coming in, the kind of Bitcoin focus, the crypto focus, and the explicit, hey, we are going to be the crypto capital of the world, which kind of gives you, in addition to kind of loosening the regulations, it kind of gives you this feeling that, hey, we're not going to be prosecuted for this, whether soft power or hard power. And then the third thing was, there's been a few shifts. There's the OCC charter that came out, but the big shift in my mind was actually the SAB 121. That day was like the turning point for crypto in financial institutions. So maybe for those of you who may not know, SAB 121 is this accounting bulletin. This is we actually had one of CFCC chairman over at dinner at our house. So it was interesting to hear like the backstory of this, but kind of unpolitical, purely factual take. The SEC is not supposed to govern commodities. That is the CFTC's job. The SEC put out this bulletin saying, it wasn't an official rule. Like they kind of slipped it in as an accounting recommendation because then they didn't have to get approval for it. And they went and said, hey, if you let your customers hold crypto, you must hold. There's a lot of rules, and there's a couple overlapping rules. But the gist of what it turned out is you must hold $1 on your balance sheet for every dollar that your customer holds in crypto, which is absolutely wild, right? If your customer holds $1 billion of crypto, you have to have just $1 billion on your balance sheet just chilling there. Like that's, and that, we were talking to the head of all the largest banks, and they basically said, we cannot do it because of this rule. And it wasn't even a rule. It was a suggestion. You should probably do this, with the implication being, if you don't do this,
it's like the mafia makes a suggestion.
Yeah,
you should probably pay us some
exactly
protection money here.
Exactly. So what happens is now this rule is replaced. The reign of terror is over. And, it's several things: Gensler resigning, the SAB 121 being repealed, the Bitcoin, Trump saying crypto is going to be, the US is going to be the world crypto capital. It's like several things in succession. But I think the SAB 121 in particular was like the concrete specific day where I remember, again, we work with these a lot of banks, and it's under NDA, and I don't want them to see this podcast and be like, what are you saying? So just think of like one of the largest banks in the world in the United States reached out to our team on Twitter. They reached out to our team on Twitter that day. They got an intro for one of our investors, and they emailed me personally. And it was just like, we need to talk right now. Like right now.
And what is I would imagine that for these banks, the idea they have is there's a huge pocket of effective deposits that's sitting with Coinbase, and Coinbase is facilitating all this stuff that's been offsides to us.
Yes.
And we have these guys, cash monies, and we need to offer like a competitive, basically crypto custody and borrowing. Like we need to begin to offer the effective stack of products that Coinbase is offering, but within the context of our customer platform. Is that basically like their move?
Brilliant. You should just go advise them. So short answer is yes. And there's a few nuances to that. So Coinbase has built an incredible business. So much respect for Brian for what he's done. We have huge admiration for what they've done. They've also effectively had a monopoly because the government regulation has blocked anyone else from coming in, right? And what you see is not just them looking at Coinbase, but you see this massive demand. Everyone's talking about crypto. Everyone wants access to it. And it's this highly lucrative business where you can take much, much, much higher spreads. You can take much higher. There's so many money-making opportunities. If you look at traditional finance, all of these opportunities have been arbed out, and it's like, 0.00001%, yields on different things. And now in the crypto industry, you can just make so much money. The second piece of it is, I think, so the first piece is like, there's a lot of dollars at stake and you can make a lot of money. The second piece is there was a shift over the last 2 years where suddenly everyone knows about crypto. And the answer is because of these ETFs. Yes, NFTs and meme coins, but really because of ETFs. Before that, the government tells these, if you're a farmer, I grew up in small town Texas, it's like cotton capital, one of the cotton capitals of the world. And the people there are like, the government told me this is like evil internet money and, money launderers and all this stuff. And then suddenly it's like, oh, in my Charles Schwab account or whatever brokerage, I can buy a Bitcoin ETF and all my friends are making money off it. Suddenly it's no longer for like scary internet people. It's for real people like me that want to have a good investment. Before, S&P was basically the tried and true way you can make money. Now there's Bitcoin. So that was a tectonic shift. And just to give you some stats, I'm pretty sure these are public. I was told these are public, so I can say this. Fidelity, the previous largest ETF, took 8 years to become the largest ETF. The Bitcoin ETF took 6 months, and it became the largest ETF for Fidelity, right? And Fidelity manages, I think, like $4 trillion in assets or something like that. It's like insane. So I think, going back to this, the first opportunity is there's a lot of money. The second opportunity is everyone also wants crypto. The third opportunity, which I have to give the banks a lot of respect, they're really smart. They say, look, if this crypto thing plays out, this is a innovator's dilemma moment for us. This is Microsoft eating IBM. This is the entire financial system being replaced. And I think, there's various degrees of understanding and believability of this internally to the banks. But I think everyone realizes if this works, it will completely destroy their business. But, there's a wide range of will this work and in what time frame. So I think what people are realizing is it's a massive opportunity, but we also need to hedge our core business. So let's get into crypto. And in high level, there's kind of this playbook, which we've been working with, whatever, I'll just say here. It's kind of, we're going to work with them anyway. So, not without saying any kind of secret NDA things, I would say like there's this 5 or 6 step playbook, which most banks and financial institutions we're working with, we're showing them this playbook. And the playbook is step 1, you need to let your users hold crypto. So in whatever way that is, you could be an ETF, it could be custody, it could be whatever. The second thing is you need to let them first one is you need to let them buy and sell, get exposure to crypto. The second one is you need to let them custody their assets directly. So what that means is they need to be able to come to JP Morgan or Bank of America and hold the native asset, but they actually retain ownership of this in kind of a self-custodial way. And I'll explain why this is important, because in step 3, now if you set it up like that, they can access all the benefits of decentralized finance, which is concretely, let me give you one example. Instead of getting whatever 0.01% that your normal bank gives, you can get 9% pretty reliably on your crypto yield, right? If you hold Bitcoin or ETH or whatever it is. So you can get access to all the decentralized finance world. That's step 3. Step 4 is you bring your stocks and bonds and different tokenized, different kind of assets that you have on chain. And you get a lot of benefits from this. You get 24/7 trading, you get real-time settlement, you get basically the back office, the clearinghouse, the brokerage, all that stuff becomes way simpler. And it's just, you can expand to new countries way faster in terms of regulatory. There's all these benefits that you get from that. And you access a much larger market. You have a lot of these things. So that's step 4. Step 5 is you launch your own stablecoin. So now you get all the yield. Instead of using other people's stablecoins, use your own stablecoin, you get all the yield from it, and you can have it become let's say you're in Latin America, you can launch a stablecoin in Latin America. Everybody who buys and holds that stablecoin and uses as US dollars because they can't access, because their countries have $10,000 or $5,000 or $250 capital controls where you say you can't hold more than $5,000 of US dollars. Now they can have US dollars. It's a much more stable currency. And, Bank of America, whoever distributes that stablecoin, gets all the yield from that stablecoin, which is a massive business. Tether made like $14 billion or something like that. And then the last piece, step 6, is launching your own chain. So, Coinbase has done this. They launched Coinbase, which is the kind of the ecosystem chain. What that does is it turns you into a kind of Visa. Now you get all the effectively interchange fees, and there's a lot of other ways to monetize. Anybody who comes and builds on your ecosystem, you get the fees. So quickly recapping, first one is give your users ability to buy, sell crypto in any form, can be ETFs. Second one is let them hold crypto natively in a self-custodial manner. Third one is let them access DeFi and let them get yield on that and on their crypto. Fourth one is bring tokenized assets on chain. Fifth is the stablecoin, and sixth is launch your own chain.
So are we going to end up basically with, a stable coin per bank and chain per bank? I mean, right now, at least, like Tether and Circle, they've taken, 90% of the market share in stable coins. Like how do you see that kind of play out?
Yeah, I think there's a few different worlds where that can play out. You look at One of the parallels I like to look at, obviously it's different because we have the internet, but the history of money. In the early days, every bank had its own currency. Then the cities had their own currency. Then states had its own currency. And now we're in an era where it's country currency. I think eventually it'll be like global currency, which I think will be Bitcoin. That's the asset I have like 99.999% confidence in, just because too much head start. I think the way that, so you can imagine if it's like a monopoly of one stable coin or a bunch of individual stable coins. My best guess, obviously no one knows the future, but my best guess is it will be similar to how currencies in the world work, where there will be one or two kind of, US is the reserve currency, but there'll be a couple like dominant stable coins. That could be Circle, that could be Tether. It could be a bank that comes in, because remember, these people have distribution at a scale that Tether and Circle don't have today, right? If JP Morgan and Bank of America,
they have a huge deposit base. You could imagine it becomes the native asset for the deposit base.
100%.
Would be their play. No guarantee it wins, but that's why they would try.
Exactly. And I think what you'll see like a couple large currencies, and that will be a duking it out battle. You'll see like 1 to 3 big currencies that are like the dominant winners. Then I think you'll see geographically distributed stable coins. So I think LATAM will have one, potentially even like sub LATAM, like maybe like Mexico has one, and these different regions. But I think what you'll see is like really smooth interchange in being able to swap between them. The thing that will shift today, Circle and Coinbase split all the money. That's not going to happen. Like that, if you're a user, like why would I go to stablecoin? Like let's say I have an option, I can use Circle and USDC, and Circle gets all the yield, or there's another stablecoin that gets your 1% or 0.1% and gives all the yield back. Like that model will very quickly flip.
Yeah. It seems like there is between step 3 and step 4, there's like a giant leap. It's more like 3 steps and then a leap of tokenizing assets and also a garden of forking paths from there. Yeah. But I think what you left out, like step 7, or maybe it's step 3B, is it's not just the, financial assets that get pulled on chain. It's actually, like the home ownership thing. And like, there's lots of kind of things that banks have, they have kind of exposure to, but they don't really have like the full like chain custody. Like think of like the title to a house, and they have a huge mortgage against that house. Like how do they, there's like a lot of kind of like back end ownership stuff. And then that should go, like one of our theses on digital wallets is it's like consumers' ability to see everything they own is going to increase. And so then it means because it's all going to be like digitally held. And then that digital wallet piece becomes very economically valuable because you control like default choices, and you can kind of like, they'll have to be making decisions about these things. That's like a valuable spot to sit in. So
100%. So actually like two interesting thoughts from what you said. I think you will see a explosion of new business opportunities and not just business opportunities, new and beneficial and better experiences for consumers. So today you go to your bank and you go get a mortgage, right? But the bank has a lot of control over that. You don't have a ton of options. You aren't able to get a bunch of different rates. It's like, you're kind of beholden to the bank in that sense. But what if you could just put it out online and say like, hey, I'm trying to get a mortgage. Who wants to fund me in the mortgage? And maybe there's someone. The bank says, I don't have a mortgage, so like I'm doing startup life, so I'm still renting apartments. So I don't know how this works. I don't know how much the rate is, but let's say it's like 7% or 5%. Maybe there's people online in India or Africa that's like, I've done the diligence. Like, I trust this guy. Maybe there's a reputation score. I'll give it to him at 2%. I have money. Maybe those people can't get a 2% yield on it, but this is a great 2% yield. We think it's a high quality mortgage. So they're able to invest in it. So it's like you're reducing a lot of inefficiencies in the market, because today there's that information and access gap between, there's no way for you to go crowdsource your mortgage today before crypto. So there's not the regulatory framework. There's not the technology framework. There's not the access to people. There's not the access to capital. And I think like what crypto does is like democratize access to capital, right? And I think that is an example where, I don't know if you remember this back in the day, but there was a group of internet people called a DAO that tried to buy the Constitution. It was like very close to buying the Constitution. And that was just like and I actually put money into that, right? And I said, cool, this is really cool. And I think you'll see a lot more of these crowdsourced models around finance, and you'll see a lot more of this walled garden where I give the bank my money. Let me give you a concrete example. So we were trying to buy our domain name, alchemy.com, and it was quite a bit of money. And we had to we were doing our press fundraise, and we were trying to get the domain name bought before we announced to the press. And so everyone would see our news. This was like many years, like 2021, I think. And basically, we negotiated the domain name, and the domain name got negotiated maybe like 3 days before the press. So then we had to get the wire done. Literally, my co-founder had to go to Bank of America in person multiple times and beg them to do the wire. They're like, oh, we're not sure. And we had a business banker. It was like, it's like, we're not sure. This might be fraud. We can't do it, blah, blah, blah. This is literally our money. And at the end, we couldn't get our money fast enough. So one of our investors paid for it personally, and then we had to pay him back. It's like, it is not your money when you aren't able to access and move it. And it was just like this. And this isn't, we're not like in India, right? We're like Indian, but in America. And we're like literally in Silicon Valley with a business broker at Bank of America, and like we couldn't move our money out, right? So I think there's this, you live in the United States and you don't realize how it's not your money until you realize. And then when you realize, you really realize.
I want to get your take on the intersection of crypto and AI. Like how do you see AI playing into all of this? I mean, Alchemy basically provides, API access to a lot of these blockchains. How do you see this intersection, and how are you guys thinking about this from Alchemy's perspective?
It's a great question. I am super excited about this. So I actually did AI in college. Like I spent 6 years researching AI. It was actually quite funny. I did like this really, really advanced computer vision research at Stanford, and like, the most complex probabilistical graphical models and all these things. And then like a year, like while I was an undergrad in grad school, deep learning was being done. And then like a year after I graduated, deep learning like really blew up. So like everything I learned was completely useless, because it's like now you just take these neural nets and you throw a bunch of data at it and it worked. But it was really cool. So and it was really cool to like get to work in some of the labs of the people who like Andrew Ng and all these people who built AI as we know it today. The short answer here, there's a long topic, but the short answer here, I think AI and crypto are like the perfect melding. So if you think about this, kind of like, let me explain the most conceptual level. AI, I think most people watching the podcast are probably familiar with the concept of agents, basically an autonomous AI kind of program that can do different things for you. It's really interesting because in order for the agent to interact with the world, you need two things. You need communication protocols between the agent and services. You want an agent to order DoorDash, you need to have DoorDash. You need to have them talk to DoorDash. You want to search the internet, you need to have them talk to the internet. If you want them to work with another agent, you need to have them talk to the other agent. That is accomplished by the internet and like kind of other types of protocols. The second thing is you need to have them be able to transact with each other, right? They need to be able to pay DoorDash. They need to be able to pay another agent. They need to be able to pay, another service. How do you do that? Agent can't have a bank account. Sure, maybe you give them your bank account, but like even if you give them, but one, you're gonna have multiple agents, you can't give them all bank accounts. Two, your bank won't let your agent use your bank account. Number three, even if you give them a bank account, how do you pay someone? If you have a bank account, how do you pay someone on Twitter? You can't, right? There's like no way to do it, right? So crypto is fundamentally the rails that AI is gonna run on. It's like, it is the financials. It's even more than humans. Crypto was made for AI because AI cannot get a bank account. AI cannot walk into a branch. AI cannot have a checkbook. And this is the way it's going to be built. And you see really cool things happen. So in crypto, agents have actually blown up even before the traditional world. And the reason is because to monetize them, you can have a token attached to them. So Virtuals is one of our partners that we work with. It's an agent protocol. There's some really interesting things. I'll give you this example. So there's an agent called Luna that they launched. And it was this Twitter agent. And they said, hey, your objective is to get 100,000 Twitter followers. And they just let the agent loose. And what the agent realized was the first thing was they said, hey, I need a profile pic. So there was another agent that made profile pics. So it talked to that agent on Twitter through like a tweet thread and said, can you make me a profile pic? This agent said, sure, but send me $1 of crypto. And then he sent $1, this agent sent $1 of crypto to the other agent, and then Luna used that as a profile pic, which is really cool. That wouldn't have happened. The second thing, which I think is maybe even cooler, the agent said, okay, if I need engagement, I need some cool background photos and stuff. So then it tweeted out, hey, anybody who makes me a background photo, I will pay $500 to the best ones. These humans started designing photos for the agent, posted them to the agent, and then got the $500. So I think the really cool thing here is just like you have, and imagine kind of going back to the pre-internet era, if the agent had to write mail and physical mail and send it on the postal service, there would be no agents. But we have this information superhighway where anybody can interact with the internet and interact with anybody else. So now you have this capability to be able to communicate. Similarly, with crypto, what you see is before the agents couldn't pay other agents because there's no bank account. Now they have this financial transaction system. And I think those are the two pieces you need. If you think about what a human needs to interact with the rest of the world, it's really just two things. It's communication and transfer of value. And those are the two pieces, and crypto is the second one. So I think crypto will be the layer underlying all of AI.
Yeah, I mean, going back to your kind of the idea of underwriting somebody's mortgage from across the country or whatever, to me, it seems like more likely you will have a set of like agents acting on behalf of users that are going to do the underwriting, right? As in like prediction markets could be valuable, but they're actually not fine-grained enough yet. Like I can't use a prediction market to predict the fire risk for my specific house because there's like not enough liquidity in that market and enough people competing to like arbitrage any inefficiencies in that price to get the right true prediction.
Right.
But once you have like a set of voracious kind of like profit-seeking agents out there that have been trained on the, X meme coin landscape to maximize kind of their return on capital, then suddenly you have like this set of actors that can come in and efficiently price markets to then provide the opportunity for the individual or the enterprise to actually do a risk transfer when it's in their best interest to allay some risk so that they can actually deploy capital in a way that kind of minimizes their risk relative to the like underlying return they're seeking. And in my case, insure my house. And so like one of the things, like even going back to kind of like the democratizing finance, if you look at the history of financial innovation, and in some ways financial innovation is all this, it really is providing wholesale pricing to retail users. Like the size you need to be in order to get the wholesale pricing is getting smaller and smaller. Like securitization of mortgages was just a mechanism by which, we're going to take a bunch of people's mortgages and squish them together so that they get more like a bond price that a corporate would get, but then it's shared across all of them. Now you can like split those back apart and still have them get like specifically priced for that user. And you don't have to go through the same, it has to fit in this cookie cutter of like, you can only do this loan to value and it can't be a house above or a mortgage above this size. It should actually fit individual to the risk profile of the user and the collateral against which they're trying to borrow. And so by like collapsing the fixed cost of the underwriting, the public blockchains allow for that, the individual user to basically get the wholesale pricing that previously you would only get because you had to pay for Morgan Stanley's balance sheet and pay for their lawyers and stuff to like construct the contract. And that all just gets like wiped away.
100%. And that's a great point. And you get access to those opportunities that you couldn't get before. It's just not discoverable or accessible to you. And I actually think, Brett, you made a great point earlier. Crypto will be the rails underlying AI, but it's a symbiotic relationship. AI gives a 10x, 100x better user experience. Now you don't have to manage your wallet, you don't have to manage keys, you don't have to send transactions. You just tell your agent like, hey, pay Brett for that thing, and it handles it, right? And I think that AI I think we've made a lot of advances over the years. One of the things I will say, I think one of the big shifts this year that I've noticed is this technology-wise, it's not a big shift, but user experience-wise is game-changing. The shift from Chrome extension being your browser extension being your primary wallet to mobile being your primary wallet. The number of people who have Chrome extension is probably like sub 50 million. And the number of people who have mobile devices is like nearly everyone on the planet. So like maybe like 5-6 billion people in the world have mobile devices. So I think that shift was amazing because now, your parents can use crypto. Or we were at a bachelor party for one of the guys on our team in Miami. And the guy who was like helping us out at the restaurant was like, oh yeah, I trade meme coins on Phantom, right? And I think that was a big shift from Chrome extension to mobile. I think mobile to AI interface will be like a 1000x shift on that. So I think it's very, very exciting. This is very like symbiotic relationship.
I think, in the last year, with, at least for myself, just like the patterns of reading articles and writing has like just dramatically changed, right? It's way more intent based. Like it's scary.
Yeah.
And so I think, for the intersection of AI and crypto, I agree with you, Nikil, in terms of user experience. Like it definitely seems that, at least to me, from the kind of the investor point of view, a lot of the products that we're using right now, they're just going to look dramatically different, right? Like a wallet where you basically have to go to Uniswap, make sure, the URL is the right one, pull out the MetaMask, approve the transaction, choose the pool. It's just like, clearly, I think this, like in a year and a half, or even, probably even before that, that is going to be dramatically different.
100%.
And so I think that, is one of the big points, especially in crypto. User experience, custody, key management. Those have been like huge barriers, I think, for users and institutions just in general.
I very much agree.
Well, so I lost my video, but I'm going to finish us off, Nikil, for over the next 5 years, what is Alchemy's ambitions? Like, where do you see kind of Alchemy going, and within what crypto context do you think that you will be most successful?
And advice to crypto builders, Nikil, like what should people focus on? Yeah.
Great question. Okay, 2 things. On the first question, our focus has always been about building a really broad platform with all the services you need. I think we're the only people who have the full platform. Anything you need to build, we can help you build. As a result, we don't take a battle stance on you have to use Ethereum or you have to use Solana or this or that. It's like we work with everyone. We partner with everyone. For developers, our job is to serve developers. Whatever you need to build, we will be here to help you. And that, to us, is the core vision and will be for the next 5 years moving, next 5, 10, 100 years moving forward. Our goal is really to build Apple or Microsoft or Amazon, not to go flip this and sell it. The second thing that I'm really excited about over the next, especially year or two, we have the full stack of tooling for enterprises. If you're an enterprise, it's like, you want to work with a company that will be around in a few years. And, we've raised $500 million, which is a small amount for like JP Morgan, but compared to other people in the space, I think the only ones who have like the full platform and can give you that sense of scale. So we are very focused on helping financial institutions enter the space. The reason being, we are so excited about their large user bases that they're bringing in. We're also working with a lot of consumer apps, consumer finance apps. So for us, it's really about helping developers, whether in enterprise or in Web3, build great applications. Nothing has changed in that, and that will continue to be in the future. The second thing, for advice for builders, man, it's such an exciting time. And you always feel like you're a little too late. In 2017, we felt like we were too late. Mark Andreessen has a great quote where it's like, you're almost always too early. And what I will say for people is, if you're trying to build a startup, I would only do it in crypto or AI. I think those are obviously the 2 fields that are exploding. AI, I would say the benefit is you get to be in a little bit more mature field. Like we said, it's been around for 80-ish years. And there's a lot of applications coming out and a lot of really interesting things and super exciting. Crypto, it's a little earlier, but the flip side is you can build some of the more foundational companies and you can have a lot of impact that may not be as accessible in AI. It's hard to go build a new transformer model and compete against OpenAI today, but the early crypto layers are just being built out. It's not even clear which chain yet is going to be the absolute dominant winner. There's a lot of potential there. So what I will say for builders, the thing not to do is go read a couple articles online and go try to come up with a business idea and make a pitch deck. This was honestly the mistake we made when we were in 2017 when we were starting. We just read a little bit about crypto and brainstormed a bunch of ideas and didn't really work out. And what the number one piece of advice I have to crypto founders, anybody building a space, I would say three components. The first one is get really deep into the problem space. Like Lorenzo, you're saying, go use all the apps, go make a trade on Uniswap, go use a wallet. If you use any crypto app for 5 minutes, you'll be like, okay, there's 1,000 ways this could be better. So it's very obvious. You don't need to theorize about it. Just actually use every product. It will be and code and build things. It will be very obvious for you. The second thing is, I would say, just ship. I think I see a lot of people come up with ideas and ideate and make pitch decks and all that stuff. Crypto, especially with like a coding agent now, you can just build something. I started doing this thing where I'm building one app a day for 100 days. And it's like sub an hour, I can build a full product effectively, right? And I think I would just go build stuff and ship it. And I think that's the most important thing. And then third thing, which sounds obvious, but a lot of people don't do it, get customer feedback and actually just talk to people using your product and see if you can like validate that, right? So I think if you do those three things, don't worry about the other stuff. Don't worry about fundraising. Don't worry about marketing. Don't worry about any of this kind of stuff. Use the products, build something, and actually just see if people want to use it. That would be my advice. If you do those three things, you are better off than like 99.99% of people. And if you do those three things continuously and continue to iterate, you'll learn a lot and end up with a good outcome.
Step 4, attach a meme coin to your product.
Step 4. So, 100%.
All right, Nikil, thank you so much for coming on FYI, the For Your Innovation podcast. Enjoyed the conversation. We look forward to a great future for Alchemy and public blockchains and crypto generally. I think it's an interesting time in history, and I'm happy to live in an interesting time. So thanks for coming on.
Thanks for having me.
What a fascinating conversation and a fascinating guy. Alchemy, I think, is in an interesting spot in the ecosystem. There are a number of other companies that sit in that layer. Blockdaemon is one, and he mentioned a few others. It does seem that over time, we will pay less attention to the mechanics and more attention to the benefits we get from using public blockchains. And I look forward to living in that future. Please like and subscribe, FYI, in whatever podcasting platform you are listening on. You can do it right now. You can open your app and you can hit that 5-star button. We love those 5-star reviews. If you have any topics you want us to cover or questions for me, I'm available at Winton Arc on X, and I may even respond. Okay, enjoy your day and tune in again next week.
ARC believes that the information presented is accurate and was obtained from sources that ARC believes to be reliable. However, ARC does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from ARC. Historical results are not indications of future results. Certain of the statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on ARC's current views and assumptions, and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.